Welcome to This Explainer. Today, we are bringing some serious energy to a topic that literally affects every single one of us. It doesn't matter if you're a Wall Street day trader or if you're just a regular person trying to build a solid retirement. We're demystifying tech bubbles. We're going to look at how they inflate, exactly why they burst, and how this whole financial roller coaster directly impacts your everyday wallet.
Okay, let's dive right into this. We'll be looking at the anatomy of a bubble, the 5 market phases, the economic domino effect, and finally, strategy and survival.
Section 1, Anatomy of a Bubble. Uncovering the hype versus reality.
You know, the fundamental challenge every single investor faces is trying to separate unadulterated hype from actual corporate reality. So what is a tech bubble? It happens when the market prices of tech stocks rise far, far above their actual intrinsic value. We aren't just talking about a stock having a really good week here. This is when intense speculation and wildly inflated expectations completely overtake logic. People just start buying high-risk assets, hoping the price will just keep skyrocketing, and they completely ignore long-term stability.
And this brilliantly illustrates the core conflict at the heart of every single bubble. On one side, you've got market price. That's just what buyers and sellers are trading for today on the open market. But on the other side, you have intrinsic value. This is the heavy lifting, the true calculated worth based on real profits, real cash flow, and underlying financial health. In a bubble, the gap between these two things, it becomes an absolute chasm.
So what actually pumps up these crazy valuations? Well, it's basically a perfect storm. Cheap borrowing from low interest rates naturally drives investors to hunt for bigger returns in high-risk tech. Media coverage completely amplifies the hype, and that draws in inexperienced investors. Then add a massive flood of venture capital to the mix, which allows highly unprofitable startups to go public, plus retail investors driven by social media FOMO. When all these forces combine, the only reality check left to expose the illusion is the actual corporate earnings reports.
Section 2, the 5 market phases, the life cycle of speculation.
Now, what's really fascinating here is that tech bubbles aren't just random accidents. They follow a highly predictable psychological and financial pattern. We can actually track the exact 5 phases. First, it always starts with displacement, where a new technology emerges and creates genuine, totally justified excitement. Then comes the boom phase, where money starts pouring into anything even loosely connected to that tech. After the peak, we hit profit-taking. That's where institutional investors quietly lock in their gains and sell. And finally, panic and cleansing, where a single trigger event drops prices, panic spreads like wildfire, and the market crashes right back down to reality.
But right in the middle is phase 3, the euphoria phase. This is the absolute danger zone. During this phase, all those careful valuation metrics we talked about, entirely ignored. People aren't buying because the math makes sense. They're buying because their neighbor just bought a boat with tech stocks and they want in too. Financial logic gets thrown right out the window in favor of pure, blind FOMO.
Section 3, the economic domino effect. From Wall Street to Main Street.
Let's see how this builds, because when that euphoria inevitably ends, the shockwaves absolutely do not stay on Wall Street. It starts with an initial shock. Maybe a prominent tech firm just misses its earnings, and boom, stock prices fall rapidly across the entire sector. Companies suddenly lose massive market capitalization, meaning their total value absolutely plummets. Because of this, venture capital dries up almost overnight. To survive without that cash, unprofitable firms resort to mass layoffs. And when people lose jobs, consumer spending drops, which ultimately slows down the broader economy. It is a direct, brutal chain reaction.
So here is how this fallout practically hits you at home. Check your retirement accounts. If your 401k or pension fund is heavily concentrated in large-cap tech, you need a brace for severe volatility. Job opportunities shrink rapidly as companies ruthlessly cut their costs. And actually, this gets all of us, prepare for higher subscription prices on your cloud storage and streaming services. These companies are suddenly under massive pressure to show actual profits. As a result of all this, you'll see a huge shift of money out of tech and into tangible alternative investments like real estate.
Section 4, strategy and survival, navigating the noise and mitigating risk. All right, so the main goal here is to navigate through all that noise. Think of this systematic review process as your personal financial shield. First, calculate valuations. Check the price to earnings and price to sales ratios against historical averages, meaning figure out exactly how much you are paying for every single dollar the company actually makes. Next, assess the revenue. Is the money coming from real, recurring customers? Third, review macro indicators like inflation and central bank policies. And finally, for sure, diversify your assets into bonds or defensive sectors, like healthcare, so you just don't get caught up in the panic.
Now, right when we think we have the whole shebang figured out, we have to introduce a major plot twist. What if it isn't a bubble? What if this incredibly overvalued-looking market is actually just legitimate, revolutionary growth? See, acting on incorrect bubble assumptions carries some really serious risks. First is timing. You might be 100% right that a sector is overvalued, but a bubble can literally still expand for years. If you pull out of fear too early, you face a massive opportunity cost, meaning you miss out on years of completely legitimate gains. Plus, standard historical valuation metrics sometimes completely fail to capture the true explosive value of modern digital assets. That can lead to some major false alarms.
And so the crucial point here is the concept of the innovation exception, the idea that some highly valued companies actually deliver revolutionary products that completely justify their expensive stock prices over time. Bubble analysis is a nuanced tool. It's not a perfect crystal ball. Sometimes a sky-high price tag is simply the cost of entry for tech that genuinely changes the world.
So, I'm going to leave you with this to think about. Are you investing in intrinsic value, or are you just buying into the euphoria? Understanding the life cycle of a tech bubble gives you the power to separate game-changing innovation from fleeting hype. Keep your eyes on the real numbers, stay diversified, and whatever you do, don't let FOMO make your financial decisions. Thanks so much for joining me on this explainer, and keep questioning what's really behind the next big tech trend.